Have you ever seen a number that makes even the most seasoned investors pause? A number so high it feels impossible, yet it is rooted in math, history, and the very foundation of global debt? $3,146 per ounce of silver. That is the number that went viral this week when Tavi Costa from Missouri Capital released his calculation. The financial media didn't cover it. Analysts debated it quietly. But the implications, if even a fraction of it is remotely possible, could reshape wealth, markets, and investment strategies for the next decade. Is it madness, or is it a disciplined decoding of the hidden economy? In the next few minutes, you'll see the step-by-step math, the historical context, and the ratios that underpin this extreme scenario. You'll discover why gold's role, the Dow-to-Gold ratio, and silver's industrial demand all converge to make this number not just plausible, but a warning signal for anyone holding wealth today. By the end, you'll understand what's possible, what's realistic, and why even conservative estimates could still multiply your perspective on the silver market. But first, imagine a scenario where every assumption Tavi Costa used is challenged, yet the direction remains clear, and the results are life-changing. Welcome to Boring Currency Stats, the channel where the hidden economy is decoded for thinkers, entrepreneurs, and investors who refuse to ignore structural truths. If you haven't already, hit that subscribe button, and tell us, from which city or country are you watching this video today? Silver to $3,147 isn't just a number, it's a signal, a warning, and the beginning of a story that spans decades of debt, gold, and market psychology. During World War II, the United States faced debt levels that dwarfed its economy, yet 51% of that debt was backed by gold reserves. Half the nation's obligations could have been covered by gold. That discipline anchored the dollar, giving confidence even in the most expensive war in history. Fast forward to today, U.S. debt has exploded, yet the gold backing has collapsed to around 3%. The same 261.5 million ounces of gold remain in reserves. But the gap between debt and gold has widened exponentially. The ratio that once offered stability now signals vulnerability. Tavi Costa's calculation starts here. If gold were revalued to cover even a fraction of current federal debt, the numbers produce a gold price in the tens of thousands per ounce. And when that is paired with historical gold to silver ratios, silver could reach $3,147. At first glance, this seems absurd, but the math is consistent. The assumptions are aggressive, yes, but grounded in patterns that have repeated throughout modern history. Each ratio, each historical precedent, each debt benchmark, they all point to a market dynamic that most mainstream media refuses to highlight. Even when the assumptions are cut in half or moderated, silver still comes out multiples higher than today's trading price. Conservative calculations still point to hundreds of dollars per ounce, while moderate assumptions suggest 500 to 800. And aggressive but plausible scenarios break 1,000. The lesson is not about chasing extreme numbers. It's about understanding the structural forces at play. Debt expansion, gold repricing, and silver's unique position as both an industrial and quasi-monetary asset. Those who decode these dynamics now, who study ratios and patterns, may be among the few prepared for the repricing cycles that have historically reshaped wealth. This is not speculation. This is analysis. The math is real. The ratios are verifiable. The historical precedent is consistent. And silver, though small in total market size, has the capacity to amplify every shift in gold and debt valuation. The question isn't whether silver is undervalued. It clearly is. The question is by how much and over what time frame. Even conservative versions of the math tell a story that could alter investment strategies and business planning for the decade ahead. History, ratios, and structural economics converge to tell one clear message. Silver's biggest move may still be ahead. There is a chart that most retail investors never study, yet many of the world's most disciplined capital allocators watch it carefully. It does not trend on financial television. It does not appear in quarterly earnings calls. But historically, it has marked turning points that reshaped decades of wealth. It is the Dow-to-Gold ratio. This ratio measures how many ounces of gold are required to buy the Dow Jones Industrial Average. In simple terms, it shows whether financial assets are expensive relative to hard assets, or the other way around. When the ratio is high, stocks are dominant. Confidence in growth, credit, and corporate earnings is strong. When the ratio is low, gold dominates. That usually signals stress in the monetary system. Over the last 100 years, this ratio has followed a striking pattern. It peaked in 1929 before collapsing during the Great Depression. It rose again into the mid-1960s before falling sharply into 1980. It reached an all-time extreme near the year 1999 when optimism about technology and globalization was at its peak. Each time the ratio reached those upper extremes, a long process of mean reversion followed. Mean reversion is not dramatic at first. It does not announce itself. It unfolds slowly, then suddenly. In 1973, the ratio stood near levels similar to where it stands today. At that time, few believed gold would outperform equities in a meaningful way. Stocks had been the preferred vehicle for growth. Gold was viewed as outdated. Yet over the following years, as inflation accelerated and economic confidence weakened, gold rose sharply while equities stagnated. By 1980, the ratio had collapsed toward 1. At that point, 1 ounce of gold could purchase nearly 1 unit of the Dow. That shift was not random. It reflected a repricing of financial assets relative to monetary stress. Analysts who study this history do not argue that the exact same path will repeat. They argue that extreme ratios rarely persist indefinitely. Today, the Dow-to-Gold ratio remains elevated compared to long-term trough levels. It has declined from its peak, but it has not reached historical extremes associated with deep monetary stress. This is where the debate becomes strategic rather than emotional. If the ratio compresses toward 2.5, not even to the extreme low of 1, and if equity markets remain roughly stable, gold would need to rise substantially to close the gap. Even a partial reversion could imply prices far above current levels. Critics argue that modern markets are different. Central banks are more sophisticated, financial systems are more complex. But history suggests that complexity does not eliminate cycles. It often amplifies them. The core question is not whether equities will collapse. The more subtle possibility is that equities could move sideways in nominal terms, while gold rises in response to debt expansion and currency pressure. That is precisely what occurred during much of the 1970s. For entrepreneurs and business leaders, this distinction matters. A flat stock market combined with rising hard asset prices creates a very different capital environment. Borrowing costs, real returns, and purchasing power all shift. The ratio also reflects confidence. When investors believe that corporate profits can outpace inflation and debt, equities command a premium. When confidence weakens, capital rotates toward assets perceived as stable stores of value. The Dow-to-Gold ratio is therefore less about gold itself and more about trust in the system backing paper assets. Some analysts argue that the current cycle did not truly reset in 2011, when gold last peaked. They note that global debt has expanded significantly since that time. If debt pressures are greater today than they were at the previous peak, then the repricing process may not be complete. This interpretation reframes the present moment. Instead of viewing recent gold strength as a new cycle, it may represent the continuation of a longer structural adjustment that began around the late 1990s. Such adjustments unfold over years, not months. They test patience, they challenge consensus, and they often look unreasonable in the early stages. If the Dow-to-Gold ratio continues to compress, it will not be because of speculation alone. It will reflect shifting confidence in debt sustainability and monetary stability. That shift, once underway, tends to influence silver as well, but with greater volatility. For now, the ratio serves as a quiet warning. It suggests that equity dominance may not be permanent. It hints that the balance between paper wealth and hard assets may still be adjusting, and if history offers any guidance, those adjustments rarely stop halfway. Silver rarely leads the story. It usually follows gold. But when it moves, it tends to move with greater speed and greater force. That is why serious analysts treat it as both opportunity and risk. After examining debt levels and the Dow-to-Gold ratio, attention shifts naturally to the gold-to-silver ratio. This relationship measures how many ounces of silver are required to buy 1 ounce of gold. It is simple, it is old, and historically, it has revealed moments of extreme imbalance. At present, the ratio remains elevated compared to long-term compression levels seen during major precious metals bull markets. In practical terms, gold is expensive relative to silver. History shows a repeating pattern. During early stages of monetary stress, gold attracts capital first. It is recognized globally as a reserve asset. Central banks accumulate it. Institutions trust it. Silver reacts later, but when it does, the ratio compresses. In 1980, during the last great inflationary surge, the gold-to-silver ratio fell dramatically. Silver outperformed gold in percentage terms. It did not do so quietly, it did so violently. This pattern explains why the 3,140 settlement projection captured attention. The figure does not rely only on high gold prices. It depends on strong ratio compression. If gold rises significantly and the gold-to-silver ratio contracts toward historic lows, silver multiplies the move. It becomes a leveraged expression of monetary stress. But leverage cuts both ways. Some analysts caution that silver's role in the global system has changed. Unlike gold, silver is not held in large quantities by central banks. It does not sit at the center of sovereign reserves. Instead, it serves a dual purpose. It is both an investment metal and an industrial input. This dual nature makes silver complex. On one side, industrial demand supports long-term usage. Silver is essential in electronics, solar panels, medical equipment, and advanced manufacturing. As global technology expands, baseline demand persists. On the other side, industrial usage can fluctuate with economic cycles. A recession can reduce manufacturing output, temporarily lowering consumption. This tension is central to the debate. If silver were purely a monetary asset, its behavior would closely mirror gold. If it were purely industrial, its price would track economic growth. In reality, it exists somewhere between those extremes. That hybrid status explains why the gold-to-silver ratio tends to compress late in cycles. Once gold establishes the monetary narrative, speculative and investment capital rotates into silver, seeking higher percentage gains. Analysts studying this pattern often model three scenarios. In an aggressive case, gold reaches elevated levels due to debt repricing, and the ratio compresses toward historical lows near 19. Under those combined conditions, silver rises dramatically. In a moderate case, gold strengthens significantly, but the ratio compresses only toward 25 or 30. The outcome is still substantial, though less extreme. In a conservative case, gold rises modestly and the ratio falls only to around 35. Even then, silver delivers strong percentage gains relative to its starting point. The important insight is not the specific target. It is the sensitivity of silver to small changes in assumptions. A minor shift in ratio expectations produces a major difference in price outcomes. This sensitivity explains why silver generates debate among disciplined investors. It is not simply about belief in metals, it is about probability. If the gold repricing thesis holds even partially, and if historical compression patterns repeat even halfway, silver responds disproportionately. However, if gold fails to advance meaningfully, or if the ratio remains stubbornly high, silver underperforms expectations. For business leaders evaluating capital allocation, this creates a strategic decision. Silver offers asymmetric potential, but carries volatility risk. It tends to overshoot in both directions. Historically, during periods of monetary adjustment, silver has not moved in steady increments. It has experienced rapid expansions, followed by sharp corrections. Timing, therefore, becomes critical. What makes the current discussion unusual is the scale of global debt and the relatively small size of the silver market. Compared to sovereign liabilities measured in trillions, the total above-ground silver supply represents a small pool of capital. When small markets absorb even modest institutional flows, price reactions can be amplified. That structural imbalance is what gives silver its explosive reputation. It does not require every investor to shift. It requires only a marginal shift in capital flows relative to available supply. This is why analysts approach silver with caution but not dismissal. It has a documented history of outperforming gold during late-stage repricing cycles. Whether the current environment qualifies as such a cycle remains the core question. If it does, silver will likely not move quietly. And if it does not, it will remind investors that leverage without confirmation can be costly. As the story comes into focus, the implications for business leaders, investors, and capital allocators become clear. This is not a tale of instant wealth. It is not a financial fairy tale. It is a strategic warning embedded in economic history, debt dynamics, and the behavior of precious metals. The first point of concern is debt itself. U.S. federal debt continues to expand at a pace unprecedented in peacetime. Annual deficits exceed trillions of dollars, and global sovereign liabilities mirror the same trend. Meanwhile, assets capable of providing stability, gold and silver, remain finite and largely static. This creates a fundamental imbalance. Analysts argue that this imbalance cannot persist indefinitely without a market-driven correction. Such a correction could take many forms: currency devaluation, repricing of hard assets, or shifts in global capital allocation. For business leaders, this means that traditional planning assumptions, cost of capital, purchasing power, and risk management, may be underestimating the stress building in the system. Silver, in particular, stands at the intersection of multiple pressures. It is industrial, it is monetary adjacent, and it is historically responsive to shifts in debt valuation and gold repricing. The market for silver is comparatively small. This means that even modest institutional or private capital flows can have outsized effects. At the same time, historical patterns provide guidance. When the gold-to-silver ratio compresses, silver tends to accelerate faster than gold. When the Dow-to-Gold ratio reverts toward historical norms, gold rises. Together, these forces create a scenario where silver amplifies the repricing of assets already underway in gold. Business leaders must understand that these are not speculative predictions in isolation. They are derived from observable, repeatable patterns over decades. Ignoring them is equivalent to ignoring a structural warning signal. Supply constraints further intensify this scenario. Mining production cannot expand instantaneously. New projects require permits, development, and labor. Even if prices rise, supply responds slowly. Meanwhile, industrial demand is growing, particularly in renewable energy, electronics, and advanced technologies. This combination of constrained supply and rising demand creates a natural upward pressure on price. Critics point to technological substitution or temporary market corrections as potential offsets. While valid, history shows that these forces are rarely sufficient to fully counter the macroeconomic pressures imposed by extreme debt expansion. The practical takeaway for decision makers is strategic positioning, not speculation. Allocating capital with awareness of historical patterns and systemic imbalances can protect value and create optionality for extraordinary outcomes. Conservative allocations may already experience meaningful gains if historical ratios partially repeat. Moderate allocations position portfolios for substantial growth, while aggressive allocations anticipate extreme scenarios, though with higher volatility. Timing remains a central factor. Cycles measured in decades do not move in weeks or months. Patience is essential. However, being late to recognize structural shifts can be costly. Historical examples demonstrate that the largest gains accrue to those who understand patterns before they are fully acknowledged by the broader market. Moreover, potential catalysts exist that could accelerate these dynamics. A sudden currency crisis, unexpected sovereign debt downgrade, or revelation of institutional silver reserves could compress timelines. These are not hypothetical abstractions. They are plausible outcomes, given current fiscal and geopolitical trajectories. Ultimately, the story of silver and gold is a cautionary tale about leverage, liquidity, and trust. Markets are not static. Ratios stretch and snap back. Debt grows and pressures assets to reprice. Business leaders who recognize these forces gain strategic clarity. Those who ignore them risk being unprepared for structural shifts that, while rare, are historically consistent and potentially transformative. In conclusion, the 3,147 figure is a theoretical extreme, not a guaranteed outcome. Yet even conservative interpretations suggest silver could rise multiple times over from current levels if historical patterns partially repeat. The magnitude of potential repricing is not merely large, it is transformative. For entrepreneurs, investors, and decision makers, the lesson is straightforward. Understand the forces at play, study the ratios, respect the cycles, and prepare strategically. Ignoring the lessons embedded in debt, gold, and silver is not an option for those who intend to preserve or grow capital over the coming decade. History has provided the signals. The ratios are flashing. The markets are quietly adjusting. The question is not whether these shifts will occur. The question is how prepared you will be when they do.